Imagine a world without banknotes, coins or credit cards. A world where all transactions happen instantly, digitally, without intermediaries. Does it sound too futuristic? Well, this reality may be closer than we think. In recent years, the way we deal with money has changed dramatically. From barter to metal coins, from paper money to digital transactions, each new financial technology has redefined the global economy. But what comes next? With the advancement of cryptocurrencies, government-issued digital currencies and artificial intelligence in the financial sector, the days of money as we know it today may be numbered. Let's explore what money will be like in 2050. Will physical money disappear? Will cryptocurrencies replace national currencies? Will we have a completely automated economy? And how will these changes affect our financial freedom? If you want to understand the future of money and how to prepare for it, stay until the end of this video. The future is already being written, and it may be very different from what we imagine. 1. Money yesterday and today, financial evolution. Money is one of humanity's most important creations. It has constantly evolved throughout history, keeping pace with advances in society and technology. But are we about to witness the greatest transformation ever seen in the global financial system? To understand how money will work in 2050, we need to look back and understand its evolution. How did we move from barter to digital money? How have currencies been shaped by economic and technological changes? And what does all this tell us about the future? The beginning of everything: barter and the need for money. Before the invention of money, ancient societies used barter, that is, the direct exchange of goods and services. If a person had wheat and needed meat, he would trade his harvest with a cattle rancher. But this system had a big problem. It was hard to find someone who wanted exactly what you offered and had what you needed. This made transactions inefficient and limited the growth of trade. To solve this problem, ancient civilizations began to use goods of universal value, such as shells, salt, precious metals and even cocoa beans. These items were accepted by everyone and made exchanges easier. But the real breakthrough came when societies began to mint metal coins, made of gold, silver and copper. China, around 1000 BC, and the Roman Empire centuries later, used standardized coins to simplify trade. This marked the beginning of money as we know it today. The paper money revolution and the rise of banks. Over time, carrying large amounts of metal coins became a problem. Gold and silver were heavy and difficult to transport in large volumes. Then, around the 7th century, China developed the first paper money, a system that allowed people to exchange paper certificates that represented a certain amount of gold or silver held in a bank. This idea spread throughout the world, and in the 17th century, in Europe, the first banks began to issue banknotes, guaranteeing that whoever held that piece of paper could exchange it for gold or silver. But then something radically changed. Governments began to print money without direct backing in precious metals. In the 20th century, especially after World War II, the world adopted a system in which currencies were no longer tied to gold. This gave governments more control over their economies, allowing them to print money as needed. But it also opened the door to problems such as inflation and currency devaluation. The digital age, cards, online banks and the fall of physical money. In the late 20th century, physical money began to lose ground to electronic transactions. The advent of credit and debit cards allowed people to make payments without having to carry cash. Banks began offering online services, and digital bank transfers became commonplace. Today, with digital wallets, contactless payments, and QR code transactions, physical cash is increasingly obsolete. Countries like Sweden and China have already drastically reduced the use of banknotes and coins, and some cities are completely cash-free. But this transformation is still ongoing. With the rise of cryptocurrencies, central bank digital currencies, and artificial intelligence in the financial sector, cash as we know it today may be on the verge of disappearing. The present and the future. Are we heading for the end of physical money? The digitalization of money is already a reality. Applications such as PayPal, Pix, Apple Pay and Google Pay allow instant transactions, eliminating the need for paper money. At the same time, the number of ATMs is decreasing, as fewer and fewer people withdraw physical money. But what does this mean for the future? Will physical money still exist in 2050? Or will we be living in a completely digital world? 2. The end of physical money. A reality soon ahead? Physical money was once present in almost every transaction in the world. But in recent years, bills and coins have been disappearing from people's wallets. Digital transactions are growing at a rapid pace, and some countries are already close to eliminating physical money altogether. But does this mean the definitive end of bills and coins? What would happen if all money were digital? What would be the benefits and dangers of a world without physical money? The decline of bills and coins. If we go back just a few decades in time, almost all purchases were made with cash. However, in the last 20 years, the use of physical money has fallen dramatically. Today, many countries are already becoming cashless societies. Let's look at some examples. Sweden, currently, less than 10% of transactions in the country are made with physical money. Many establishments no longer accept bills and coins, and the government intends to completely eliminate physical money in the coming years. China, the country is leading the digital payments revolution. Apps like WeChat Pay and Alipay have taken over the market, and the use of cash has fallen dramatically. In some Chinese cities, it is almost impossible to pay for something without a smartphone. Norway, Denmark and Finland, these Scandinavian countries have also significantly reduced the use of banknotes, promoting digital payments as the main form of transaction. Brazil, the launch of Pix in 2020 transformed the country's financial landscape. With free, instant transactions available 24 hours a day, Pix has caused many Brazilians to abandon the use of physical money. The reasons for the end of physical money. But why is physical money disappearing so quickly? There are several reasons that explain this transformation. 1. Comfort and practicality. With the growth of smartphones and the internet, digital payments are faster and easier. There is no need to carry bills and coins, count change or go to the bank to withdraw money. 2. Security against crime. Physical money can be stolen, counterfeited or lost. Digital payments, on the other hand, have extra layers of security, such as passwords and biometrics. In many countries, the reduction of cash has led to a significant drop in crimes such as robberies and assaults. 3. Greater financial control. With digital payments, it is easier to track and manage expenses, as all transactions are automatically recorded. Banking apps and digital wallets help people organize their finances and avoid debt. 4. Cost reduction for companies and governments. Producing bills and coins is expensive for governments. In Brazil, for example, the central bank spends billions of reais per year just to manufacture money. Companies that only accept digital payments avoid the costs of transporting valuables and security. What would happen in a world without physical money? The idea of a world without banknotes may seem futuristic, but it is becoming increasingly real. However, it raises important questions. What would happen if physical money disappeared completely? Advantages. Fewer crimes. Without physical money, crimes such as robberies and corruption would become more difficult. More efficiency. Transactions would be instantaneous and globalized, eliminating banking bureaucracy. Greater government control. Governments could better monitor the economy and prevent illegal activities. Disadvantages and risks. Lack of privacy. If all money is digital, all transactions can be monitored by the government and financial institutions. This raises concerns about individual freedom. Exclusion of people without access to technology. Many elderly and low-income people still rely on physical cash. Vulnerability to cyber attacks. A 100% digital financial system may be more prone to hacking and technological failures. Will physical cash disappear by 2050? Based on current trends, it seems inevitable that physical cash will continue to lose ground. But will it disappear completely by 2050? Experts believe that some countries may eliminate banknotes and coins entirely within the next few decades. However, in emerging economies and poorer regions, physical cash may continue to exist for longer. But if we no longer use banknotes, what will the money of the future be? Cryptocurrencies? Government digital currencies? Artificial intelligence controlling all transactions? 3. Cryptocurrencies and blockchain, the future of transactions? The digitalization of money is happening before our eyes. And while physical money is losing ground, a new candidate is emerging to take its place: cryptocurrencies. But are they really the future of financial transactions? Or are there still barriers preventing their mass adoption? Let's explore how Bitcoin and other cryptocurrencies are revolutionizing the concept of money, the role of blockchain technology in this transformation, and whether, by 2050, cryptocurrencies could replace traditional currencies. What are cryptocurrencies and how do they work? Cryptocurrencies are decentralized digital currencies, that is, they are not controlled by governments or central banks. They use blockchain technology to record transactions in a secure, transparent, and immutable way. But what does this mean in practice? 1. Decentralization. Unlike the dollar or the euro, which are issued by central banks, cryptocurrencies operate without a central authority. This means that no one can simply print more coins, as governments do with traditional money. 2. Security and transparency. Transactions are recorded in a public digital ledger, the blockchain, accessible to anyone, ensuring total transparency. Since the data is encrypted, transactions are extremely secure and virtually impossible to defraud. 3. Speed and low cost. International transactions can be completed in minutes or seconds, eliminating intermediaries and reducing banking costs. In many cases, fees are much lower than those charged by banks and traditional payment systems. Bitcoin and other cryptocurrencies, the beginning of a revolution? Bitcoin was created in 2009 by an anonymous developer known as Satoshi Nakamoto. The idea was simple but revolutionary: to create a financial system where people could send and receive money without relying on banks or governments. Since then, thousands of cryptocurrencies have emerged, each with different functions and purposes. Some of the best known include Bitcoin, BTC, the first and most valuable cryptocurrency, used as a store of value, and digital gold. Ethereum, ETH, a platform that allows the creation of smart contracts and decentralized applications. Ripple, XRP, focused on fast and cheap international payments. Stablecoins, USDT, USDC, DAI, digital currencies pegged to the value of the dollar, offering stability to the crypto market. But if cryptocurrencies have so many advantages, why haven't they replaced traditional money yet? The challenges of mass adoption of cryptocurrencies. Although cryptocurrencies have gained popularity, there are challenges that prevent their global adoption as a substitute for traditional money. 1. Extreme volatility. The price of cryptocurrencies can vary drastically in a matter of hours. Bitcoin, for example, has already seen drops of more than 50% in a few months, which makes it difficult to use as a stable means of payment. 2. Lack of regulation and global acceptance. Many governments still don't know how to deal with cryptocurrencies. Some countries encourage their use, while others, such as China and India, have imposed restrictions. Cryptocurrency acceptance in commerce is still limited. Although large companies such as Tesla and Microsoft have already accepted Bitcoin, most businesses still do not use this technology. 3. Scalability issues. Some networks, such as Bitcoin, can become congested, making transactions slow and expensive. To address this, new technologies such as the Lightning Network are being developed to make Bitcoin more efficient. 4. Security and risks. Although blockchain is secure, many investors have already lost money in scams and hacks on exchanges. Without a bank or government to protect funds, the responsibility for security falls entirely on the user. Blockchain, the technology that could change the world. Despite these challenges, the real revolution may not be in cryptocurrencies themselves, but in the technology that underpins them: blockchain. Blockchain is not only useful for digital money. It can be applied to several areas, such as smart contracts, programs that automatically execute agreements without the need for intermediaries. Property registration, proof of ownership of real estate, vehicles, and even works of art in a secure and transparent manner. Digital voting, safer and fraud-proof elections. Supply chain, monitoring of products from their origin to the end consumer. By integrating blockchain with artificial intelligence, big data, and the Internet of Things, IoT, we can create a future where financial transactions are instant, secure, and decentralized. Will cryptocurrencies be official money by 2050? The big question is, will cryptocurrencies completely replace traditional money by 2050? Experts point to three possible scenarios. Scenario 1. Total cryptocurrency dominance. Cryptocurrencies become the main form of money in the world. Governments lose control over monetary issuance and people use decentralized currencies for all transactions. Scenario 2. Coexistence between digital and traditional currencies. Cryptocurrencies continue to grow, but coexist with traditional currencies. Central banks create their own digital currencies, CBDCs, to compete with decentralized cryptocurrencies. Scenario 3. Cryptocurrencies continue in parallel. Bitcoin and other cryptocurrencies remain as financial assets, but they do not completely replace traditional money. Governments impose stricter regulations to prevent cryptocurrencies from threatening the global financial system. Regardless of the scenario that comes to fruition, one thing is certain. Money is changing, and cryptocurrencies are a fundamental part of this transformation. What now? How to prepare for the future of money? Whatever the future holds for cryptocurrencies, understanding this technology today can be a differentiator for those who want to prepare for the new economy. Here are some tips to keep up with this revolution. Study how cryptocurrencies and blockchain work. Diversify your investments, including cryptos as an option. Follow regulations and government positions. Test the use of digital wallets and payments with cryptocurrencies. The financial world is evolving rapidly. If in just a few decades we have moved from physical money to digital payments, what can we expect for the next 30 years? 4. Central Bank Digital Currencies, CBDCs, money controlled by the state. Cryptocurrencies like Bitcoin have challenged the traditional financial system by offering a decentralized alternative to government-controlled money. But central banks around the world have not been left behind. In response to the growth of cryptocurrencies and the digitalization of the economy, several countries have started to develop their own official digital currencies, the so-called CBDCs, Central Bank Digital Currencies. But what are these digital currencies? Will they replace traditional money? And what are the consequences of a fully digital and centralized financial system? What are CBDCs and how do they work? A central bank digital currency, or CBDC, is a type of digital money issued and controlled directly by a government. Unlike Bitcoin, which is decentralized and operates without a central authority, CBDCs operate within a system that is fully regulated and monitored by the state. CBDCs can be seen as a digital version of the currencies we already use today, but with some fundamental differences. They do not rely on private banks to intermediate transactions and can be programmable, allowing governments to have unprecedented control over the financial system. To better understand the impact of CBDCs, let's compare their main aspects with current financial systems. 1. Issuance and control. Unlike physical money and bank deposits, CBDCs are issued and controlled directly by central banks. This means that governments can regulate their supply instantly. 2. Instant and intermediary-free transactions. CBDCs allow for fast digital transactions, without the need to go through private banks or payment processors like Visa and MasterCard. 3. Traceability and monitoring. Every transaction made with a CBDC can be recorded and monitored by the government, eliminating the anonymity of physical cash transactions. 4. Programmability of money. Unlike traditional money, CBDCs are programmable, meaning governments can set rules on how and where the money can be spent. Which countries are already creating their own digital currencies? Global interest in CBDCs has been growing rapidly. Today, more than 100 countries are researching, testing, or implementing official digital currencies. Here are some of the most advanced cases. China, Digital Yuan, ECNY. China is a pioneer in the implementation of a CBDC. The Digital Yuan, or ECNY, is already being used in several Chinese cities and could become the official currency for international payments in the future. Europe, digital euro. The European Central Bank, ECB, has already begun studies to launch a digital euro, with the aim of modernizing the European Union's financial system. United States, digital dollar. The Federal Reserve is exploring the possibility of creating a digital dollar, but there is much debate about how it would affect the traditional banking system. Brazil, Drex, digital real. The Central Bank of Brazil announced Drex, a digital version of the real that will be integrated into the country's financial system, facilitating transactions and making payments more efficient. Advantages of CBDCs. What can they improve? Central bank digital currencies bring several advantages over physical money and even current digital financial systems. Let's look at some of the main improvements they can offer. 1. Greater efficiency in the financial system. Payments will be processed instantly, eliminating bank delays and reducing costs with intermediaries. 2. Financial inclusion. People without access to banks will be able to have a digital wallet directly at the central bank, allowing greater financial inclusion in emerging countries. 3. Combating money laundering and corruption. Since all transactions are traceable, governments will be able to combat financial crimes more easily. 4. Reducing costs of issuing physical money. Banknotes and coins are expensive to produce and keep in circulation. CBDCs eliminate these costs. 5. Monetary stability. Unlike decentralized cryptocurrencies, CBDCs are backed by governments, which ensures greater stability and acceptance. The dangers of government digital currencies. But it's not all good. CBDCs also raise serious questions about privacy, government control, and financial freedom. Here are some of the main challenges and risks of these digital currencies. 1. End of financial privacy. With CBDCs, every transaction can be monitored by the government. This means that no purchase or transfer will be completely anonymous, which raises concerns about surveillance and control of the population. 2. Possibility of total control of money. Since digital money can be programmed, governments could impose restrictions on the use of CBDCs. For example, limit spending on certain categories of products. Set expiration dates on money, forcing people to spend it quickly. Block transactions from individuals deemed problematic by the government. 3. Risk of devaluation and inflation. If a government prints CBDCs without control, the currency can quickly lose value, damaging the purchasing power of the population. 4. Exclusion of the non-digitized population. People who do not have smartphones or access to the internet can be left behind in a fully digital economy. Will CBDCs replace traditional money? The big question is, will central bank digital currencies completely replace physical money by 2050? Experts suggest 3 possible scenarios. Scenario 1. The world fully embraces CBDCs, all payments and transactions occur digitally. Physical money is completely eliminated and people use only digital wallets linked to the central bank. Scenario 2. Coexistence between CBDCs and traditional money. CBDCs become mainstream, but physical money continues to exist for those who prefer to use it. Scenario 3. CBDCs fail and physical money remains. Technological barriers, popular resistance, or economic crises prevent CBDCs from becoming universal. Regardless of the scenario that materializes, it is undeniable that the financial system is undergoing a radical transformation. How to prepare for this new financial system? Whatever the future of money, one thing is certain: digitalization is inevitable. People and companies need to adapt to this new reality. To prepare for this revolution, it is important to understand how CBDCs and cryptocurrencies work. Diversify investments to reduce risks. Monitor global financial regulations. Protect your digital privacy in an increasingly monitored world. 5. Artificial intelligence and finance. Will money be autonomous? Artificial intelligence is already revolutionizing several sectors, but its impact on the financial world could be one of the most transformative. In 2050, will we still be making financial decisions on our own? Or will algorithms and AI completely control our money, investments, and even our consumption habits? Artificial intelligence is already present in financial markets, banking automation, and investment analysis. But what comes next? Will banks no longer need human employees in the future? Will our accounts and investments be managed by autonomous robots? Is AI already in control of finances? Although it may seem distant, artificial intelligence already plays a crucial role in today's financial system. Let's see some ways in which it is already changing the world of finance. 1. Automated trading algorithms. Currently, around 80% of trading on the US stock exchange is done by AI algorithms, which analyze the market in real time and execute buy and sell orders in milliseconds. These robots eliminate the emotional influence of human investors and maximize profits for large companies and investment funds. 2. Digital banks and automated service. Intelligent chatbots are already replacing human attendants in many financial institutions, solving problems and providing personalized support to customers. AI systems analyze each person's financial habits and suggest banking products, such as personalized loans and investments. 3. AI-based credit and lending. Today, many banks use artificial intelligence to approve or deny credit applications. Instead of relying solely on banking history, AI analyzes other factors, such as financial behavior, recent purchases, and even interactions on social networks. 4. Fraud and financial security. AI is also essential for detecting bank fraud and protecting online transactions. Advanced systems can identify suspicious patterns of behavior in real time and block fraudulent activities before they cause damage. The future. AI controlling all the money? If artificial intelligence already plays such an important role in the financial system today, what will it be like in 2050? Let's explore some of the most likely predictions for the future of money under the control of AI. 1. Fully automated financial management. In the future, AI will be able to manage our money completely autonomously. This means that an intelligent virtual assistant will be able to pay your bills automatically, organize your monthly budget and suggest spending cuts, invest your money based on your risk profile, create personalized financial strategies to maximize your returns. 2. Artificial intelligence deciding on investments. If there are already investing robots today, by 2050 we could have systems that make even more complex decisions, without the need for human intervention. AI will be able to analyze global data, political crises, economic changes and market trends to suggest the best investments before a human being even notices the opportunities. 3. Smart currencies and autonomous transactions. Future digital currencies could be programmable, allowing AI to execute transactions without the need for user authorization. For example, an AI could detect that a car insurance policy is about to expire and automatically renew the payment before the deadline. 4. The end of traditional banks? With AI managing money in an automated way, banks may cease to be physical institutions and become fully autonomous digital platforms. The concept of a bank manager may disappear, being replaced by virtual financial assistants that operate 24 hours a day. Risk or opportunity? The dangers of AI in the financial system. But it's not all advantages. Like any technology, the use of artificial intelligence in money brings challenges and risks that need to be considered. 1. Lack of human control. If AI is fully responsible for people's money, what happens if there is an error in the system? Erroneous algorithms or cyberattacks could cause financial collapses. 2. Over-reliance on technology. If money is completely digital and managed by AI, what happens in case of system failures or technological blackouts? How will people be able to access their funds without functional technology? 3. Market manipulation. Large corporations or governments could use AI to manipulate financial markets, favoring certain companies or harming competitors. 4. Privacy and total monitoring. If AI manages all of your finances, this means that all of your financial transactions and decisions will be recorded and analyzed. Governments and companies will be able to monitor and influence individual financial habits in unprecedented ways. AI and the future of work in finance. Artificial intelligence will also have a direct impact on the financial sector's job market. By 2050, many banking and finance roles could be automated, replacing human jobs with algorithms. Professions that could disappear or be reduced: bank managers and financial advisors, credit analysts, stock traders and brokers, in-person banking services. New careers that may emerge: financial engineers specialized in AI, cybersecurity experts to protect digital transactions, creators of algorithms for investment management. In other words, AI can completely transform the economy, but it will also require workers in the financial sector to adapt to this new reality. Are we ready for a 100% automated financial system? If artificial intelligence already influences money today, imagine what it will be like in 2050, when technological advances are even more impressive. The big question that remains is, are we ready for a world where AI fully controls our finances? Will financial decisions become better, or will we lose control over our own money? 3 scenarios for the future of AI in the financial sector. Scenario 1. AI takes full control. Virtual financial assistants take care of all people's transactions, investments, and financial planning. Money becomes 100% automated and programmable. Scenario 2. AI and humans work together. Artificial intelligence helps with financial decisions, but humans still have ultimate control over their finances. AI improves efficiency, but without removing human autonomy. Scenario 3. Technological risks limit the use of AI. Security issues, system failures, and social resistance prevent the full automation of money. Banks and governments create strict rules to limit the power of AI in the financial sector. What do you think? Will money be fully autonomous by 2050? And do you think AI will be an ally or a risk for the money of the future? 6. What will the global economy look like in 2050? Money is evolving faster than ever. In the last few centuries, we have gone from gold to paper money, then to cards, and now to digital transactions. But what about the future? What will the global economy look like in 2050? Will we have a single global currency? Or a decentralized financial system, without the need for banks and governments? Artificial intelligence, cryptocurrencies, and central bank digital currencies, CBDCs, are already transforming the way we use money. But how will these changes affect the global economy? Will countries continue to control their own currencies, or are we moving towards a new global financial system? The end of traditional money and the emergence of a new system? The global economy has always been in constant change. In the 20th century, the dollar consolidated itself as the world's main currency, becoming the reference for international trade and investment. But this reality may be about to change. With financial digitalization, physical money is disappearing and new forms of transactions are emerging. Among the possible scenarios for 2050, some experts believe that we could move towards a world with a single global digital currency. But what would this mean in practice? What would be the advantages and challenges of such a system? Scenario 1. The world adopts a single global currency. One of the most radical scenarios for 2050 is the creation of a single global currency. This would mean that all countries would use the same digital currency, eliminating the exchange system and facilitating international transactions. Advantages of a single global currency: no more exchange rates, international travel and business would be much easier, as there would be no need to convert currencies. Greater economic stability: it would avoid crises caused by currency devaluations and monetary manipulation by governments. Ease of global payments and investments: companies could operate without exchange barriers, accelerating global trade. Challenges and risks of this system: loss of economic sovereignty of countries. Without control over their currency, governments would no longer be able to adjust their economic policies to face crises. Who would control this currency? Would it be managed by a global central bank or by artificial intelligence? Who would make decisions about inflation and money issuance? Concentration of financial power: if a central entity controlled the global currency, there could be risks of economic monopoly and abuse of power. Scenario 2. total decentralization of the economy. On the other hand, an opposite scenario is also possible. A world where there are no longer central banks controlling money. Instead, the global economy could be based on a fully decentralized financial system, driven by cryptocurrencies and blockchain. In this scenario, people would no longer need banks to store money or make transactions. Instead, everyone would have secure digital wallets and could make transactions directly, without intermediaries. Benefits of full decentralization: greater financial freedom. No government or bank could freeze your account or control how you spend your money. Lower fees. Without intermediaries, transactions would be faster and cheaper. Accessibility for all. People without access to banks could participate in the global economy with just a cell phone and an internet connection. Challenges and risks of this system: financial volatility. Without a government to regulate money, financial crises could be more frequent. Difficulty in implementing a global system. Each country has different financial laws and rules, which would make this model difficult to adopt globally. Digital security risks. If all money were digital, hackers could become an even greater threat to the economy. Scenario 3. The hybrid between government digital currencies and cryptocurrencies. Between these two extremes, there is a third, more likely scenario. A world where government-issued digital currencies, CBDCs, coexist with decentralized cryptocurrencies. In this model, countries continue to issue their own digital currencies, but citizens can also choose to use cryptocurrencies and other digital assets. This would strike a balance between state control and financial freedom. How would this hybrid system work? Governments would maintain their national digital currencies to ensure economic stability. Individuals could choose between using official currencies or decentralized cryptocurrencies. Businesses could accept payments in different forms, promoting greater financial flexibility. This model could offer the best of both worlds: the security of government currencies and the innovation of blockchain technology. The role of artificial intelligence in the economy of 2050. Regardless of the financial system that prevails, one thing is certain: artificial intelligence will be the key player in the global economy in 2050. With the advancement of AI, we can expect 1. Autonomous and self-adjusting economy. Artificial intelligence will be able to predict economic crises before they happen and automatically take measures to avoid them. Central banks could use AI to adjust interest rates and inflation based on real-time analysis. 2. Personal financial assistance. Instead of making financial decisions on our own, we will have AI assistants that will manage our money in an optimized way. These systems will be able to suggest investments, calculate risks, and even create personalized financial plans. 3. Companies managed by artificial intelligence. Some companies may be fully managed by AI, without the need for human CEOs. The stock market may be dominated by algorithms that make buying and selling decisions with maximum efficiency. How to prepare for the economy of 2050. No matter which scenario comes to fruition, one thing is certain: money and the global economy will not be the same as we know them today. To prepare for this new era, some actions may be essential. Learn about new financial technologies. Understanding how cryptocurrencies, CBDCs, and artificial intelligence work will be essential to keep up with the changes. Diversify investments. With so much uncertainty, not relying on just one currency or financial system may be the best strategy. Protect financial privacy. In an increasingly digital world, ensuring the security of your transactions will be more important than ever. Adapt to new ways of working and earning. Automation and AI may change the way we earn money, so being prepared for new careers will be essential. What now? What do you think the economy will be like in 2050? The world is changing rapidly, and the money we know today may not exist in the next few decades. What do you think? Are we moving towards a single global currency? Towards a fully decentralized system? Or towards a hybrid between the two? Leave your opinion in the comments and join this discussion. If you liked this documentary, subscribe to the channel, activate the bell, and share this video with your friends. The future of money is being written now, and whoever prepares best can come out ahead.